Good evening, everyone. Welcome to our Mississippi State Alumni Workshop. My name is Jason Maida. I'm going to be your host for this evening. It's great to get a chance to present to you your very first Homebuyer Workshop, and really excited to be able to partner with each of you. This is a new partnership for us with Mississippi State Alumni, and so really just really thrilled to get a chance and really grateful to be able to get a chance to support you in homeownership. So this class is generally about an hour-long class. It's very interactive. So what that means is and we encourage you to ask questions as we roll through tonight's content. We teach this content from kind of a nationwide perspective, but we'll look specifically at the Mississippi State market, or the state of Mississippi, I should say, the market, and kind of we'll focus in on some data points there. But we really want to provide this as resources and support for you on that path towards home ownership. So whether you're thinking about buying this year in 2024, or this is a 2 or 3 year goal for you, we just want to let you know you have all the resources and support you need for home ownership. Let's go ahead and dive in now. We're going to kind of kick off our class. And my name is Jason Maida. I'm work with a company called American Pacific Mortgage. And so, as I mentioned, we're a partner with Mississippi State Alumni. It's just a new partnership for us for this year, but we couldn't be more thrilled to be in partnership. We're a company that's based out of California, but we're a nationwide company. So we have brick and mortar offices all across the country. We're licensed in virtually every state across the country. So wherever you're joining us from this evening, we're here to help support you in your local neighborhood. And out of curiosity, I'd love to kind of know where you're joining us from tonight. So, I mean, if you have a chance, pop in the chat and just kind of put where you're joining us from. I'd love to hear what city you're attending tonight's class, because as I go through some of the market content, like, looking at what housing prices are doing or what interest rates are doing, some of it will be, more relevant for you in your certain market that you might be considering. By the way, as a side note, as I mentioned, this is going to be an interactive session. So if you do have questions as I roll through tonight's presentation, feel free to drop those in the Q&A, and then I'll answer those as I go through tonight's content. We'll also carve out some time just before the top of the hour to do some more Q&A. But like I said, this class will run just about an hour. A little bit more about me. I've been in the lending industry for over 20 years, believe it or not, and I specialize in education for first-time home buyers. So whether you're buying in Mississippi or Texas or the Midwest or California, whatever it looks like, we're here to help educate you on home ownership. For those of you that dropped your location in the chat, thank you for that. We have some from Texas, Mississippi, Missouri. That's awesome. So it's really good for me to kind of get a sense of where everybody's at, because that really helps me in kind of sharing with you a little bit more about these details. We're going to talk tonight about several different things. And, one of them is going to be just the resources we think you need as first-time home buyers. But we'll spend some time in just a minute looking at a budgeting exercise. We want to kind of compare, if we're current renters today, what's it going to look like for me to go from renting to home owning, and what's my budget and what are the upsides to owning, or maybe some of the takeaways, right? We'll look at the housing market. Want to spend some time looking at some general national statistics. We'll look at interest rates, kind of what's on the horizon for interest rates. We'll talk about credit. We'll look at the impact of student loans to eligibility. We'll spend some time looking at loan programs, some of the documentation that you might need if you decide to get on the path towards home ownership. We'll look at some assistance programs, both from a nationwide perspective, as well as some localized programs within the state of Mississippi. And then we'll wrap up tonight's discussion looking at the buying process. So after tonight's call or class, you're like, hey, you know what? I think I want to put together a home buying plan for myself and design some goals and objectives for home ownership. We can help you with that through a consultative process. That's a no obligation option for us. And we'll spend some time talking a little bit more about that later on in tonight's class. Well, the fact that each of you have taken time out of your busy Wednesday nights to kind of learn a little bit more about home ownership is a big deal, right? Because this is probably going to be one of the biggest investments that you decide to make in your upcoming financial futures. With buying a home, there's some benefits that come along with owning a home. Obviously, I'm not going to be paying rent any longer to a landlord, so I don't have to worry about my rent going up on a monthly basis. my home will ideally go up in value over time, which is called appreciation, right? So whatever I owe on my home versus what my house is now worth, that difference is called equity. And that equity helps you create wealth. Now, some markets go up higher in value than others, but long-term real estate should appreciate over time. And this is an asset. So this asset, as it appreciates, it creates more wealth for the family, but also an asset to pass along to the heirs of your estate. And believe it or not, there's still some really good tax benefits that come along with owning a home. So when we look at, and we're going to look at just a budgeting exercise in just a second, there is a lot of great benefits that come along with owning a home. And it's not what I would say like is an apples to apples comparison. It would be, it's a completely different look when we're looking at home ownership because of all the really great benefits that come along with owning a home. So with that said, I want to walk us through a budgeting exercise. And this is our rent versus buying calculator that I have on our screen share now. And what we're going to do is kind of just talk through what this looks like if I was to continue down the path of renting versus what is it going to look like if I decide to take the next steps in home ownership. So and just want to kind of preface this all by saying I do realize maybe some of the data points here might not be completely accurate for those of us that might be buying in Missouri or Mississippi or Texas or California, whatever the case may be. So we'll just kind of use this as a baseline number for tonight's discussion. All of the material that I present to you this evening is going to be sent out to you via email tomorrow morning from our team. So the entire presentation, as well as these links, will all be included. So I would encourage you, if you have some time, maybe get a chance to use some of these tools yourself and kind of see what that budgeting might look like for you. So let me walk you guys through the calculator and so you can see what this looks like for yourself. So if we did kind of a hypothetical here, let's say I was paying rent of $17.50 a month. So we had that entered. We have monthly renter's insurance, which we assumed at $15 a month. We have our rent expectation saying that rent could go up like 5% on an annualized basis. And then we have our home purchase amount. Now, some of us might be a little shocked by 400,000. Others might think, oh, that's not a bad number. But again, we're just kind of creating a little bit of a baseline for ourselves for tonight's discussion. So if we had a $400,000 purchase price, the minimum down payment to purchase a home is 3%. You're going to learn more about that in our program section in just a little bit. We have property taxes for the home. Property taxes will vary based upon where you're going to purchase in the state. If you're in Texas, those taxes might be a little bit higher than, say, in Mississippi or California. Homeowners insurance, we have the maintenance cost that we're going to plug into our calculator. And then as we kind of move further along, actually, let me back up just a second. Let me open up the rent tab here. I just want to point out that we've plugged in $15 for our renter's insurance, and then again we assumed the 5%. So that's our side of renting. This is going to be the side of homeowners. So we're going to say $400,000 minimum down payment, 3%, and then these are all kind of the assumptions we make in taxes, homeowners insurance, and then maintenance costs. And then the other homeownership information that we want to plug in, we're going to look at loan information. So we're going to assume a 30-year fixed mortgage, average interest rate somewhere around 6.5%, give or take. Origination charges, those are the costs that you pay as part of your overall closing cost to purchase a home. Origination charges are specific to the lender. Now, one of the cool things about our partnership with Mississippi State Alum is we're going to pass along a discount for you in our origination charges. So if you choose to do financing with us, we'll discount our services by $750, which is a nice little add-on benefit for you. Now, discount points are going to be where you decide to pay additional out-of-pocket expenses to lower the cost of your interest rate. So what that means is that, let's say I have a 6.5% interest rate, and I really want to achieve a 6% rate. Well, as a buyer, I can pay additional money out of pocket to help lower that interest rate. So if I paid 1% of my loan amount, that's called 1 point. Generally speaking, 1% of my loan amount will equate to about a 0.25% reduction in interest rate. So in my example, if I want to go from 6.5 to 6%, I probably would have to pay 2% of my loan amount to achieve that level of interest rate. Okay. I'm not a huge fan of buying points right now. And the reason for that is because this market is still, hopefully turning downward in interest rates. So at some point, our prospective homeowners that become existing homeowners down the road, they will have an opportunity to refinance their home when rates kind of more normalize to historical levels. And the return on investment for buying points is usually for about 2 to 3 years. There'll probably be an opportunity to refinance in 2 years from now. So paying points to buy down a rate doesn't always necessarily make a lot of sense. Now, in buying a house, there's also other closing costs, which would include maybe attorney's fees if you're in an attorney state, title, escrow fees, some of the transfer charges for your respective counties, things of that nature will fall under what we call as closing costs. So those are another item of savings for us in homeownership. Generally speaking, closing costs will be the equivalent of 2 to 3% of my sales price that I will need in available assets. And then the last section is in assumptions that we're going to make is we're going to assume our home will hopefully appreciate about 4% on an annualized basis. I know that will vary based upon where we're buying in the country. We're going to expect our home will be in our home for 7 years. That we eventually sell the home in 7 years, it's going to cost me about 10% of my purchase price between realtor fees and closing costs. We have our state and federal tax rates, and then a savings rate that will plug into our assumptions. So what the calculator basically comes back to us, it says, well, first of all, we want to know what our payment difference is going to be, right? So I'm accustomed to paying about $1,700 a month in rent. Now my mortgage payment elevates up to like $3,300 a month, based upon a purchase price of $400,000. Now, if I was to look at that over the next 7 years and compare continuing to rent versus continuing to buy, my opportunity of savings, my opportunity cost, I should say, is about $40,000 over the next 7 years if I chose to buy versus rent. And then certainly down the road, if I have an opportunity to maybe refinance my home, those numbers only get better because I'm paying less interest and I'm hopefully paying down my loan in a quicker amount of time. Okay. So that's a rent versus buying calculator. We love to kind of launch into our classes with that calculation just as kind of a backdrop for what homeownership could be for you. Now, as we look at the market, we got to look at what home prices are doing. So we're going to give you a snapshot of US housing home prices. They obviously, when we kind of drill down and get a little bit more micro into a particular state or county or city or local community, those prices will vary a little bit, but median sales price is about $402,000. We are just going into the spring buying months, so it starts to get a little busier, activity levels start picking up, weather gets a little bit nicer, and so generally that will encourage more buyers to enter the market. We're also hoping to have more homes go on the market, especially as opposed to what we saw in 2023. We're expecting inventory levels to increase by 10%. It's kind of some of the projections we're getting. It's certainly needed. Over the last year to year and a half, a lot of sellers weren't willing to put homes on the market because interest rates were so high. And interest rates at 7 or 7.5%, you're selling a home that you have a 3% interest rate on. It's really challenging as a seller to go out and buy a different home that's double the amount of interest. And so we really had some challenges from an inventory perspective, and we still do, meaning the amount of supply that's available to buyers is just not necessarily there. So we're going to have about a 10% increase in supply, like I mentioned, but the buyer activity is continuing to ratchet up. And as interest rates start to fall, generally buyer activity picks up, but guess what? Home prices will generally start to rise. And so we're really watching that pretty carefully because we are expecting a potential interest rate decrease possibly by the middle of 2024. So right now, the interest rates have elevated primarily because of the inflation levels with the US economy, right? And many of you have probably paid attention to that. Well, the Federal Reserve has ratcheted up the federal funds rate to combat inflation. There is signs that inflation is slowing, and there's some bets that the Federal Reserve will begin cutting interest rates as early as the June Federal Reserve meeting. There is a meeting coming out, meeting minutes are coming out next week, but it's not likely the Federal Reserve is going to cut rates just given what we've seen with recent economic reports. But we may see a rate cut in June, which we would love to see that. Average interest rate is around the 6.5 to 6.75 range. That's a far cry from what we saw in interest rates back on October 21st. Rates elevated to an 8% level. I've told our classes over the last several weeks, I remember exactly where I was when that happened because, that obviously created a lot of fear for us because that changes affordability for our buyers. And, the lower the interest rate is, the better for buyers. And when you get to 8% levels, that just changes the landscape dramatically. But in today's market, we're about the 6.5 to 6.75 range. I hope that we'll probably reach into the low sixes by the end of 2024 and possibly break through into the fives in 2025. So that's kind of where we stand with interest rates. But today, what our environment is really driven by what the inflationary environment looks like across the US economy. As inflation improves, hopefully interest rates will ratchet down. The Federal Reserve is looking for a 2% inflation number. So we're still a long ways away from that, but hopefully at some point we'll start to see some rate cuts here on the horizon. Now, in interest rates, they're not all the same for all buyers. Interest rates look a little bit different depending on your credit eligibility, which we'll talk about in just a second, loan products, how much you decide to finance, what your down payment might look like. And we talked about it earlier about discount points. If I want to pay additional cost as a buyer, that can play a role in my financing and in my interest rate offering. And then the term of my loan. So the lower my term I take, that could potentially lower the amount of interest rate offering. Ultimately, as we meet with you for a home buyer plan in part of your consultation, we're going to design an option that fits best for you and give you interest rate options that help fit your home buying goals, right? So, and those will vary based upon the market status of interest rates. Interest rates change every minute throughout the day. So if I was to show each of you a chart of today's interest rates, you would see kind of just, interest rates moving all over the place, because it is a moving according to what's going on in the trading in the US economy. All right, we're going to talk a little bit about credit. And again, if you have questions as I roll through tonight's content, just go ahead and drop those in the Q&A function within Zoom, and I'll answer those on air for us tonight. I want to talk a little bit about credit. It's one of the important kind of aspects of home buying. And when I work with clients across the country in home ownership, there can be usually two challenges for home ownership. It could be just savings because I don't have enough saved to purchase a home, but it can also be credit because maybe I'm a little overextended or I didn't know where my credit stood from a score perspective. So what we like to do in our classes is to get a chance to share with you a little bit more about how you can help improve your credit or maybe optimize credit on that path towards home ownership. I think it's helpful to first understand how the FICO score is calculated. I know many of you have monitoring tools that you use, like through Credit Karma or through the three agencies like TransUnion, Experian, or Equifax. What I have on screen here is the mortgage score calculation. So I think it's helpful to understand that 15% of the score calculation is how long you've had credit. So the more mature my credit file is, the higher my credit score should potentially be. 20% is going to be how much credit do I have in use, or how much new credit am I trying to obtain? That'll also translate into inquiries, and those are called hard inquiries that will impact your score. Now, good news, when you work with us and help design a plan for you, initially we only do a soft credit check because it's important for us not to impact your credit score, because we don't know, for our first-time buyers, some are looking to buy this weekend. Some are looking to buy 2 years from now. So we don't want to necessarily impact your score. We want to give you your tools and resources and design a plan for you without hurting your credit score. If you do have to do a hard inquiry for whatever reason, there's rules in place in the credit agencies which state that if you apply for auto financing or mortgage financing, you have a 30-day window of time to apply with as many lenders as you want. And it's the equivalent of one credit inquiry hit to your score, okay? But again, for our process, we're only going to start with a soft credit check. 30% is going to be utilization of credit, and we're simply looking at revolving accounts. So credit cards, lines of credit, overdraft protection will all fall into the 30% bucket of utilization. With utilization, we're looking at your total revolving credit limits versus your revolving credit balances. So if I have $10,000 in limits, my balances I know are at $5,000. That means I'm at 50% utilization. If I've recently charged up some credit card debt because I have a big trip planned, and maybe I'm at 80% utilization, then we'll probably see a little bit of pullback in our credit score. If we're running 80% utilization, we want to do our best to try to whittle that below 50% utilization. And then the optimal level is to get to 10% utilization or less. Okay. Now, let me give you a quick tip on how to best manage utilization. So if you have some time tomorrow, I would encourage you just download a quick snapshot of your most recent credit card statement. So there's two key dates on that statement. There's the billing cycle date. There's also the due date, right? The due date's when you have to make your payment. We all know that. And many of us are probably in the practice of doing that. That's totally fine. But I would encourage you to look at your billing cycle date, because the billing cycle date's the date at which the credit card issuer sends all your information about your account to the credit agencies. They send it out to all three agencies, Equifax, Experian, and TransUnion. If you can get in the habit of paying off that balance or paying it down before the end of the billing cycle date, what's going to happen is you're going to have a reduced balance that will improve your utilization. So when the data gets transferred to the agencies, you have a much lower balance, lower credit utilization, higher credit score. That should hopefully help improve your credit score. Okay, so try that as an option if you're trying to really improve that credit score. And then finally, 35% is going to be payment history. That's how I've paid my bills. If you've had some late payments, those are going to be rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe on that spectrum the late is, the bigger hit you're going to have to your score. We're really concerned about lates in the most recent 12 to 24 months. Okay. So that's kind of the snapshot of the score calculation. Now, as a lender, we look at all three different scores, but we take the middle score. And what I mean by that is if my highest score is 740, let's say my middle score is 720, and my lowest score is 700, then I'm going to take 720 as a score for qualifying purposes. Now, if my partner is going to join my application and my partner is at 700, 680, 660, then we're going to take 680 as the middle score for qualifying purposes. Okay. So, and why credit is so important is because it's going to influence your interest rate offering, like we talked about earlier, could impact your mortgage insurance, which we're going to learn about in just a few minutes, the loan program that you select. So ultimately that drives the cost of borrowing, right? So we want to help kind of educate and coach you up wherever there's an opportunity around credit. And then the last thing I would want to kind of touch on in this screen is that account closure. And what we mean by that is specific to revolving accounts. So if you decide to close out a revolving account because you no longer use it, just be careful of that, because what happens is when you close out an account, it pulls away all the great history from that account. So if I've had an account for 10 years, I close it out and I've had AAA history on that account, all that great history gets pulled out of the credit model. So it could potentially lower your credit score. So you want to be really careful with that. Okay. All right. Let's show you a quick matrix on negative credit, because if you've had some past challenges on your bureau and you just want to know, hey, when are those going to come off my credit report? This is how long they'll stay with you. As I mentioned earlier, the impact to your score will be in the most recent 12 to 24 months. Okay, before I touch on student loans, I just want to see, is there any questions from the audience around credit or any of our topics so far we've talked about? I know I've thrown a lot at the class so far, but I want to just kind of take a quick pause. Okay, looks like we're good. Okay, as a reminder, if you joined late for the class, just drop your question in the Q&A and we'll answer those as best we can on air before we wrap up tonight's class. So let's talk about student loans. And student loans have just recently come into repayment. I know there's some recent cancellation of debt that's going to be happening. So hopefully you do have some cancellation of debt. That would be amazing. But if you're still going to have some student loans, or if the student loans are in place right now, as a lender, I still have to factor those into the qualifying. If you're on an income-based repayment amount, that's totally fine. We'll take that amount for qualifying. But if you haven't yet set up a payment arrangement, then kind of by default on a conventional loan, we count 1% of the balance for your monthly payment. If you elect to do an FHA loan, so the Federal Housing Administration government insured loan, we take 0.5% of the balance as the monthly payment amount. Now, if you're back in school because maybe you're in grad school right now, or maybe you have a forbearance, if you're looking to apply for a mortgage right now, we'll still have to count a minimum payment for the qualifying purposes. So even though you're on a forbearance, we'll still have to use a minimum payment for qualifying. Okay, as it relates to loan programs, in our classes, we like to kind of talk about what your options look like, right? And so I want to kind of dive into 5 of the core programs for financing that you might have as consideration for your upcoming home purchase. So we're going to spend some time looking at 2 of the core products, but I'm going to kind of share with you all 5 of these products and what they might look like for you on your journey of home ownership. So the first one is a conventional loan, and that allows you to put a minimum down payment of 3% of your purchase price towards home buying. There is a thing called the conforming limit, and that's nationwide. So the conforming limit is 766,550. When you think about a conventional loan, you guys may have heard about the terminology or the names of Fannie Mae and Freddie Mac, right? So those are kind of quasi government agencies, but they are all they basically house the conventional loan product. 70% of all loans transacted across the US use the conventional loan product. And again, it's a 3% minimum down payment for first-time buyers. It does have a minimum credit score of 620. Now, if you're joining us from what we call as a high cost of living area, so maybe you're in New York, which I don't think anybody's from here in New York, but if you're in New York or if you're in maybe the California markets, we can at times take that maximum loan amount as high as 1,049. Oh, sorry, 1,149. So those are options in high cost of living markets. We had a question in the chat. Let me just see. Okay, we have just a quick question in the chat. I just want to answer it, and then we'll keep on going into FHA, which is how much do you suggest to have in an emergency fund for home ownership? So with this question, I think the our classmate is asking, how much should we have in case I buy a house? What should I have in reserves? I would recommend about 6 months worth of your equivalent monthly mortgage payment to have in a savings account for like a rainy day fund. So if I have a $2,000 mortgage payment, maybe have an additional $12,000 available in cash, something like that. All right, so the next product we want to talk about is an FHA loan. So a federally insured loan, Federal Housing Administration loan. It has a minimum down payment, 3.5%. It's not just for first-time buyers. You can be second and third-time buyers. In Mississippi, the maximum loan amount goes up to $498, $250. That can vary based upon where you're going to purchase in the state. The FHA loans are going to have a little bit more flexibility. Minimum credit score goes down to 580, whereas a conventional loan has a 620 credit score. We're going to talk more about a side-by-side comparison as it relates to mortgage insurance on conventional versus FHA loans in just a bit. But the misconception with FHA is that it's just going to be for first-time buyers, but it really can be for second or third-time buyers, as a conventional loan can be as well too. And then for our veterans that have eligibility for the VA home loan program, a veteran can buy a home with no money down, so it's a 0% down option. There really is no maximum loan limit on VA loans. Loans can go in excess of $1 million. Minimum credit score for the veteran is a 620 credit score. For the VA loan product, there's a lot more flexibility from a guidelines perspective. So, if there's some past delinquencies of credit, or maybe there's higher what we call debt to income ratio, which you're going to learn a little bit about later tonight. Those will give us more flexibility in the VA loan program. The USDA product is going to be for clients that chose to purchase in more rural areas. So USDA is for the United States Department of Agriculture. So they've deemed areas in the United States to be under their guidelines for their product. It also has a 0 down payment option. There's 2 big qualifiers with USDA. You have to meet the geography requirements. You also have to meet the income limits for your household size for USDA. But USDA can be a fantastic tool for you in home ownership. It also has a minimum credit score of 620. And then finally, the jumbo loan. Those are going to be for clients that need a little bit more financing, up to 10 to 15, or you're required to put 10 to 15% down generally for a jumbo loan. Usually credit scores have to be at a minimum score of 680. So it's really for clients that need to buy at the higher end of the market. Not really typical for first-time buyers. And the reason why is because obviously it's going to be a much more expensive first-time purchase. It's going to be a much more larger out-of-pocket expense, because not only do I have to save up for my down payment, my closing costs, but there's also what we call as reserve requirements with a jumbo loan, which requires you to have additional assets set aside, which are usually the equivalent of 12 months of my monthly payment. So if I have let's say a $6,000 mortgage payment, I need an additional $72,000 in assets that don't even contribute to my transaction, that are just left behind if I'm going to buy using a jumbo loan product. It really is not going to be really relevant for most of our first-time buyers, but we always like to kind of share that, because At times we'll have buyers that do need that resource. Now, I mentioned to you, we want to talk a little bit about private mortgage insurance, also known as PMI. I get a lot of questions around this throughout our classes. What PMI does is it insures the lender against potential default of the buyer. On a conventional loan, it's required when you put less than 20% down. For an FHA loan, it's required regardless of the amount of your down payment. Now, there's different ways of looking at mortgage insurance as it relates to a conventional loan, and there's different ways of paying the mortgage insurance. On PMI for a conventional loan, you have the option to pay it monthly. You can split the MI up, pay some of it monthly, some of it up front. You can also do what we call single premium MI, completely buy it out by paying that out of an expense of closing. And then you also can do what we call lender paid mortgage insurance. And that's where you're basically taking a higher than market interest rate to buy out the mortgage insurance. The most common option is usually going to be monthly mortgage insurance. And the reason for that is because monthly mortgage insurance has a cancellation option. When you have 2 years in your loan and 22% equity, you can apply to have the mortgage insurance canceled. Okay. Now, if you've started home searching on Redfin or Zillow, what you'll find is those calculators don't necessarily have the right amounts there because they don't take into consideration these 3 characteristics: credit score, down payment, and amount finance. Those will make up what your premium is. If you think about conventional mortgage insurance, it's very similar to auto insurance. So depending on what type of vehicle I'm gonna insure, where I live, how much coverage I need, all those things go into auto insurance. Very similar as it relates to PMI, but that PMI is covering insurance for the lender. If we look at a calculation of mortgage insurance, here's what it will look like. So if I bought a $250,000 house, I put 3% down. Let's say my credit score was 740. My mortgage insurance is about $135 a month. Okay. So pretty reasonable relative to the amount of down payment. Now, if I decide to purchase with FHA mortgage insurance or an FHA loan, that's going to look a little bit different. I think we had a hand raised in the room. So if you do have a question, just go ahead and drop that in the Q&A, and I'll make sure I answer that for you. With FHA loans, it looks a little bit different. So the minimum down payment is 3.5%. Monthly mortgage insurance is going to be 0.55% of my loan amount. Okay. That's for any down payments of less than 10%. Now, my upfront mortgage insurance, so that's another component of mortgage insurance for FHA, is 1.75% of my total loan amount. FHA mortgage insurance does not have a cancellation option. So regardless, if I've been in the loan for 3 years or 4 years, I can't get out of mortgage insurance for FHA unless I decide to refinance into another product like a conventional loan. And for our clients that we help support with FHA, this is probably going to be a temporary solution just to get into the home. And then hopefully as our home grows in appreciation, maybe our credit score changes, wherever our financial picture looks a little bit different, we'll hopefully try to transition over to a conventional loan at some point. Here's the payment scenario now for an FHA loan. So we take the same $250,000 loan amount, we add on upfront mortgage insurance, which is 1.75% of my loan amount. And then we have the monthly PMI, which is 11460. So that's 0.55% of my loan amount. So the mortgage insurance on FHA is a little bit lower than the conventional product. However, that cancellation option can be a bit of a takeaway, but more importantly, the upfront mortgage insurance, adding on an additional $4,300 on the balance, could sway a client to look at one option or the other. We're going to put all the options in front of you as we consult with you for home buying, right? Because we want to make sure we get the right product fit for you. And it does, when we look at the different options, it also does make a big difference as it relates to qualifying, right? Because not every client's going to qualify for conventional loans, whether it's because of credit, whether it's from an income or down payment perspective. So we're going to look at all those different attributes to figure out what the best product match for you is in homeownership. Okay, as we start our process for thinking about home buying, we're probably going to have to gather some documents together just to make sure we have kind of a good financial picture put together for us. So this is what the typical documents look like for home buying. You generally will have to get together the last 2 years of taxes, last couple of years of W-2s, bank statements for the last 60 days, last 30 days of pay stubs, or last 30 probably would be sufficient. 60 days would be great. If you're self-employed, we will absolutely need the last 2 years of taxes because we have to do some calculations on the business, probably a balance sheet and a profit and loss statement. So that's generally what we would expect to gather as documentation for home ownership to review our different options. Now, as it relates to employment, I think it's really important to understand because there's a little bit of misinformation out there as it relates to how long I need to be on my job. So one of those things is a lot of buyers think that they have to be on their job for 2 years in order to purchase a home, which really isn't the case. We were working with a client earlier today and kind of share with them how that actually works. So I have to verify 2 years of employment history and or education. So if I graduated from school, let's say in the fall, and I now started my employment first of this year, because I have my 4 years in school and now I started my career, right? That would satisfy the 2 year requirement. So that's one way of looking at it. Or I can have a 2 year total work history, right? So I could be on my job 1 month, but I've also worked for my previous employer 1 year and 11 months. That still would satisfy the 2 year requirement. Okay. In some cases where I'm on my job, but I have prospective employment where I have an offer letter, I'm going to switch jobs. At times, that new income figure from the new job can be used for your qualifying as long as you're going to be starting that job in a relatively soon amount of time, right? Now, where the 2 year requirement gets a little different is that if I have dual employment, and we see this a lot in the healthcare field. So if I work for one facility for 30 hours a week and I work for another facility for 20 hours a week, now, in that case, I do have to show that I've been on both jobs simultaneously for 2 years. The same thing holds true for part-time employment. So if I'm holding down part-time or flexible hour schedules, I do in that case have to show that I've been on my job for two consecutive years. For self-employed individuals, the 2 year requirement is also in place. So I have to show that the business has been active for at least 2 years. And if I have a full-time job, but I also do maybe, let's say I drive for Uber on the side, I have to show that I've been doing both my full-time work and Uber for 2 years if I do want to count that supplemental income. The final thing I want to share with you before we move along is that at times when we meet with clients, they may have a spouse or a partner that's contributing income to the household and to the expenses. If you don't count your partner's income or you don't include your partner on the application, then that income cannot be factored into the calculation for qualifying. Okay. So at times, some clients will also have room rentals. So they might rent out a room in their house. At times we can use that rental income, but for the most part, it wouldn't be an allowable income source. Within income as a lender, we do have to do a calculation called the debt to income ratio, which takes into consideration your expenses versus your income. And generally, we don't want those expenses to absorb more than 43 to 45% of your gross monthly income. And that can vary at times based upon our approval status, but the calculation is pretty simple. We're going to look at the homeowner's, the prospective home buying budget. So the principal, the interest of the loan, the property taxes, the homeowner's insurance of my new loan. If I'm putting less than 20% down, the private mortgage insurance. If I'm buying a condo or a townhouse, I might have homeowners association dues. So we factor that into the household budget along with any other debts. And then we divide that by our gross monthly income, and that's how we arrive at a debt to income ratio figure. And so you can see that in this calculation here, we come up with this client's debt to income ratio at 35.29, well within the qualifying. The question I get often is, well, Jason, where should my debt to income ratio be? And there really isn't the right answer for that. But I will say, in meeting with hundreds of clients across the country, it's usually the sweet spot or comfort zone is probably 33 to 36% debt to income ratio. Now, what's more important to us is to create affordable home ownership. So there's two big goals for us: affordable home ownership for you and sustainable home ownership over time, right? So even though our clients may qualify at a certain debt to income ratio, we want to design a plan for you that feels comfortable, that you can help achieve home ownership, but also be able to sustain your lifestyle with that new home, right? The last thing we want to talk a little bit about before we move into the buying process is savings and assets. Like, how much do I need to have saved for home ownership? So as we learned earlier, we have our down payment amount. We also have closing costs, which can be generally 2 to 3% of our sales price. Here's some of the acceptable sources we can use to verify some of those assets. So, your last 60 days of checking and savings accounts. At times, you can use your retirement accounts. I would encourage you to talk to your financial or tax advisor before you access those accounts. We don't want to create any tax situation for yourself. So that'd be 401ks, 403bs, IRAs. Family members can also contribute towards your home purchase. That's called gift funds. There is no seasoning requirement for gift funds, but we do have to paper trail the funds. So, our uncle can't hand us $5,000 in cash to go buy our house. That would all have to be paper trailed through the financial system, but gift funds can be absolutely allowed. It requires some documentation, which is really simple. Now, there is some challenges to homeownership, right? So I mentioned to you earlier, there's kind of two of them that I see with working with buyers across the country. It could be credit, because I'm trying to reposition credit and trying to maybe lower my outgoing debt, but it could be savings to be able to help reach that down payment and closing cost goal. So there are tools and resources to help you as first-time buyers across the country. And so in our classes, we'd like to share with you what those tools are. And I know we have many of us in tonight's class joining us from different states. So offline, we can talk about some of the first-time buyer programs. Like, I know we have one of our participants from Texas. Texas has a home buying program, or Missouri does. So there are state and local agencies that can help you with resources for down payment and closing costs. We don't have time to go through each of those tonight, but we're going to spotlight the Mississippi program as well as a national program that you can partake in if you're eligible. But I just want you to know, as first-time home buyers, there are resources to help you. And some of those are targeted at low-income buyers. Others can be moderate income buyers. So the first program I wanted to spotlight for you is the Freddie Mac Borrow Smart program. So that's a national program. What that provides for different income levels is a grant of anywhere between $500 to $1,500 that you can use towards down payment and closing costs. I realize that doesn't sound like a lot of money, but collectively towards your closing costs, it can certainly help. It's going to help buyers that are at less than 80% of the median income level in most markets. Fannie Mae, which we learned about earlier, also has a very similar program, which basically provides a grant at a very similar level of grant level. And we can certainly look at that as an option for you too in designing your home buying plan. And then in the state of Mississippi, there's also a first-time buyer program for eligible buyers. Provides you anywhere between $6,000 to $10,000 in down payment assistance. And what it is, it's basically a second mortgage that you would take out in addition to your first mortgage that's at a 0% interest rate loan option. And we could talk more about details of that for eligible buyers, but I just want to kind of spotlight some of those tools that are available for you, because many of us will put this as a 2 or 3 year goal of home ownership, whereas it could be maybe a 1 year goal, especially when we leverage resources such as this. All right, let's talk a little bit about the buying process. And so we're going to give you kind of a visual tool here, if you will, our 6 steps of home buying. And you've heard me talk a little bit about the home buying plan several times tonight. That is where we get a chance to consult with you to figure out options for you. And I'm going to give you a little bit more details on what that looks like. But the road to home ownership will first start with a pre-approval. And a pre-approval is what we have coming out of that consultation. It's kind of like our baseline financing. So you know exactly what you're eligible for, your loan amount, your sales price, what the expected interest rate is based upon the current market conditions. That pre-approval is good for 60 days. And you're going to use that pre-approval if you decide to present an offer to a seller. Now, for some of our buyers, as I mentioned earlier, the buying process may take 2-3 years. Sometimes it takes 2 or 3 months. It just really depends. We can always recertify that pre-approval for you at any time. Step 2 is going to be house hunting. Now, generally that house hunting starts online with tools like Zillow or Redfin, but we would encourage you to get connected with a local realtor that's an expert in their market that can help support you with looking at communities that help fit what you're looking for in home ownership. Okay. Now, once you've kind of set your sights on certain properties that fit your criteria and your eligibility, then you probably would want to hop in the car and go actually look at those houses and tour those. Maybe you pop into an open house. If you find a home that you love and want to present an offer to the seller, a realtor will help you in orchestrating that offer. Now, if the offer gets accepted, then we move to step 3. And that's called entering escrow. And it has different terminology in different parts of the country, but nationally, it's generally entering escrow. That escrow process will usually take 30 days. So from the time at which an offer is accepted by a seller to the time I get my keys to my house, it's about 30 days as a kind of a national average. Now, there's some action items that happen once the escrow opens. So one is as a buyer, I would need to make a good faith deposit. This also varies across the country, but usually it's 1 to 2% of our purchase price, and that amount of money needs to be delivered to the escrow or attorney's office within 2 to 3 days after the accepted offer. Once that offer is accepted, we'll be notified as your lender. We'll give you a call and say, congratulations. You know, it's a big feat just to have the offer accepted, and schedule you for a follow-up consultation. In that follow-up consultation, you meet one-on-one with me to go through the design of your financing. Make sure you feel comfortable with all your numbers, your budget, make sure that everything is aligned to what you expected. Okay. And then we'll set some action items for next steps. And then we're going to send to you disclosure of your loan. There are various iterations of disclosure out to you as you move through the process. The earnest money deposit I mentioned just briefly looks a little bit like this. It does vary for different parts of the country, but as a rule of thumb, it's a good faith investment for your home purchase. Show the seller that you have a financial stake in purchase of this home. That deposit should be protected by what we call a contingency in your contract, which that contingency states that you have your chance as a buyer to do your homework on the property to make sure it's truly a good fit. That will generally include getting your house appraised, which I will order as the lender. Want to make sure the appraised value supports the purchase price of the home. You'll organize inspections with your realtor, and then you'll get your loan approved with us, the lender. The contingency will vary state by state, but generally it's in the first 17 to 21 days that you have your opportunity to do your homework on the property. Okay, so that's a really important attribute of a real estate contract. Step 4 is going to be more of the administrative tasks of your loan, verifying your income, verifying your assets. We'll probably have your interest rate locked in at that time because interest rates vary, as I mentioned earlier in tonight's discussion. So once you have a property, we want to get your interest rate locked in so there's no variability to your interest rate. And then step 5 is going to be the issuance of your loan approval. That says that, hey, I'm approved for my financing. Everything looks good from the underwriter's perspective. And it also brings you to the end of your contingency period. So by that time, you're about 3/4 of the way through this process. You're going to report out to your realtor that your loan's approved, and we will give the acknowledgement to them to go ahead and remove your contingency if you feel comfortable after doing your homework on the property. That also tells the seller that you're ready to move to the final stages of the closing process. Before we get there, as a lender, we're going to deliver to you a final closing disclosure, which gives you a 3-day cooling off period before we get to the final milestone, which is step 6, and that's closing your loan. For all parts of the country, that closing process includes meeting one-on-one with either a public notary or an attorney or an escrow officer to sign your final documents in person. We still do that in person. Everything through every other milestone disclosures are all coming out to you electronically, but the final documents are all via in-person signing. At that stage, you will deliver to the escrow or attorney's office your final funds for the home purchase. Once those monies get reconciled, as a lender, we wire in the final funds for your home financing. And if you've elected any assistance programs, we'll help you with that too. Those monies get all balanced out with the escrow attorney team. And then documents get recorded with your local county recorder's office. And they record a couple documents. There's a grant deed to transfer ownership. They also record a deed. This is basically your security or our security instrument for the loan that you're taking out with us. And so we'll get confirmation back from the county recorder's office that those things are recorded. And then we get a chance to celebrate with you because now we've confirmed that you are now the official owners of the home. I get a chance to make at least 1 or 2 of those calls a day. That's the most enjoyable part of my day, other than teaching classes like this to you guys, because you've achieved that huge goal of home ownership, the American dream, as they will say. Because home ownership doesn't come without its challenges, but to get to the finish line and actually have a home is a big deal, and we want to celebrate it with you. So again, that's probably one of my most enjoyable parts of my day. As you're going through tonight's class and hopefully enjoying some of the information you're getting, if you're thinking about getting on the path to home ownership, we love to be a partner with you on that journey. And it starts with an online application. It's a really simple process. So as coming out of tonight's class, you would complete an online application, you would upload proof of your income and assets, and then you would meet with me one-on-one for a video consultation to help design a home buying plan for you. And there is no obligation with that consultation. So whether you think you want to buy next week, next year, or 2 or 3 years from now, We just want to be a partner with you on this path towards homeownership. Now, if coming out of tonight's class, you have a few questions about maybe a local assistance program, maybe a credit score question, program question, get connected with us for an introductory call. All our links to schedule any session with us can all be found in all the presentation material you get tomorrow morning. I mentioned to you a little bit about a consultation, so I want to kind of outline for you what a consultation looks like. We only do a soft credit check, but we're going to talk about budgeting for you, goal setting, affordability, the workflow of buying a house, really just give you this comprehensive overview so you can feel comfortable whenever that time comes that you want to take those next steps in homeownership. That consultation is going to be about 30 minutes with us. And again, that'll be a one-on-one session with me. We also have some fantastic tools and resources that are available to you. So if you want to do maybe a calculation of monthly payments on a prospective home, or you want to start the process, maybe you want to learn a little bit more about different tools that are available to you, I'd encourage you to check out our mobile app. It's available for Android and Apple. Really great tool to help support you in homeownership. And as I launched in tonight's class, I couldn't be more thankful for the opportunity to be able to present to you guys our first class with Mississippi State alum. It's a joy to get a chance to connect with you guys in this environment, although it be in a virtual environment. We also have other partnerships that we work with across the country. So, if you've enjoyed tonight's class, you have friends, family, or coworkers that are anywhere across the country that would benefit from educational tools like this, we would love for them to come check out one of our upcoming classes. You can find all of our class schedule at mortgageeducate.com for the list of all those classes. We've been teaching classes like this for almost 8 years now. We love what we do in helping support our communities in homeownership. We'd encourage you to check out what other clients are saying about us as you're thinking about taking this next steps in homeownership. And also in our socials, we try to put resources out there that will help you on this journey. So check us out on Instagram. You can find us at JMada Mortgage. I think we put a lot of good resources out there for you. And if you just want to get connected with me, here's all my personal contact information. You can shoot me a text, message me through email, whatever is easier for you. I just want to make sure that I'm here available for you and answer any questions that you might have. We're doing pretty good on time. We've carved out a little bit of time before the top of the hour. So I do want to open it up for questions from our audience. If we have anything, I know we've got a couple throughout the class, but want to ask if our audience does have any questions I can help answer for us on air. So I'll throw it out to you guys if you guys have any questions. All right, got a question that came in the chat. Question was, will we have some of these slides available later? Yes. Yeah, in case you missed it, we're going to have the presentation. Since we have your emails on file, we'll email you out all the presentation material tomorrow morning. And this will be recorded as well, too. So this will be live and up on our YouTube channel. So our YouTube channel is just JMada Mortgage, so you can find us there as well. We generally try to put refresh our content every at least a week on our channel as well. Any other questions? I think I'm right before dinner, so that's might be why I'm not getting as many questions. For most of us, it's going to be right before dinner, right? All right. I think we might be set then. Okay. All right. Well, again, thank you so much for joining tonight's class. It was a pleasure to present this content to you. We'll get all the information out to you tomorrow morning, and I look forward to connecting with each of you soon. Have a good night.